It's an all too familiar story. You've been working hard and squirreling away money every payday with the hope that over time you'll build wealth. That is, after all, what all of us were taught. Except you've now come to realise that leaving cash in the bank is slowly burning away at the value of your money, and that is why you want to turn to investing. It's why you need to turn to investing. Because the truth is, without investing, you will never become financially free. For the ultra-wealthy, almost all of their income is driven by investments. Whilst for pretty much everyone else, they trade their time for a paycheck. So to become wealthy, you should follow what the wealthy do and what the wealthy did. The problem is, where do you even begin? I'm sure you'll have already heard of the quite literally hundreds of different ways to invest, whether that be individual stocks, bonds, ETFs, crypto, property, all the way down to the more obscure investments like whiskey. Things get even more complicated when you start to talk about day trading, forex, options, and financial derivatives. But trust me, despite what some people want you to believe, it doesn't have to be complicated. And it doesn't have to be a casino either. And in this video, I'm going to tell you, from the perspective of a chartered accountant and investment banker, exactly what I would do if I was starting over, and prove that the everyday person can truly become an everyday millionaire. A decision to not invest is a conscious choice to devalue your wealth over time. It sounds extreme. It's quite extreme, I suppose, but it's also true, and I'll explain to you exactly why I say that. The reality of the global financial system dictates that over time, inflation will corrode your wealth. Now, I've absolutely no doubt that you know what inflation is. You've barely been able to get through a week over the last 5 years without it being mentioned in news headlines, but the truth is, we kind of have our thinking about inflation backwards. We typically think of inflation as the price of a basket of goods increasing from one year to the next. In fact, that is quite literally the way that it's calculated. That's not really what's going on though. What's actually happening is the value of your money is decreasing, so you need more of it to buy the same number of things. The reason for that? Well, broadly because the money supply increases faster than the rate of our production of goods and services. But what does all of this mean for you? And if it's so important, why is nobody doing it, especially here in the UK? In fact, a senior lecturer of economics at Manchester Met University showed that only 23% of people in the UK have invested in the stock market, compared to nearly 2/3 from our friends across the pond. An even more worrying statistic shows that us Brits have almost £280 billion sitting in current accounts generating zero interest, meaning we're leaving tens of billions of pounds of potential growth on the table each year. I personally think that the reason for the lack of investing in our country is twofold. An old school paradigm that's been passed down over generations which conflates investing with gambling, and an education system which deprioritizes everyday financial knowledge and know-how. But I'm here to tell you that investing isn't reserved for the already wealthy, and that you can become rich without risking it all to get there. So coming back to the different ways of investing, I'll keep it simple in this video and stick to the 3 most common investment groups. The first, which I'd argue most people are aware of, is individual stocks, where you get the opportunity to own a tiny percentage of large publicly traded companies, let's say Apple, for example, or maybe Amazon. The next is government bonds, or gilts here in the UK, where you lend an amount of money to the government in return for a fixed amount of interest, known as a coupon. Or finally, ETFs and index funds, which are a group of individual stocks bundled together, and your investment is allocated based on the weighting of the companies within the index that it tracks. The most popular, which you may have heard of, being the S&P 500, which is the 500 largest US publicly traded companies. So if, for example, you had £100 to invest, roughly £7 would go to Nvidia, which is the largest company in the index, while Netflix, which is roughly 10 times smaller, would be allocated 10 times less, so roughly 70 pence, until all of your investment is distributed across the 500 companies. This way, you don't need to research individual stocks or even really know how to evaluate an investment. There's no steep learning curve of understanding all of the technicalities involved in investing, from P&Ls and balance sheets to discounted cash flows and financial ratios. So if we put those 3 investment groups on a sliding scale of risk and reward, government bonds sit at the bottom left, given, in theory, the government shouldn't default on its repayments. And by the way, if it ever did, would have much bigger issues to worry about than the value of your portfolio, quite frankly. Then you've got ETFs, which are riskier, but come with a greater return on average. And then finally, you've got individual stocks where the risk reward profile is infinitely higher. Now, I'm an investment banker, so of course, my advice is going to be that everyone should go all in on individual stocks to generate the greatest return in the shortest period of time, right? Absolutely not. The truth is, it's incredibly difficult to consistently outperform the broader market. Over the last 10 years, only 35% of active managers outperformed passive indexes. These are often billion-dollar firms with a wealth of experience, knowledge, and armies of equity research analysts doing the hard yards and getting paid handsomely for it, by the way. And still, most fail. So the average Joe with average luck and few financial credentials is likely to struggle. Now, there are valid explanations for why so few firms do outperform the indexes, so it's not a perfect comparison, but it does give you a reference point. Bonds, whilst a safe choice, simply don't offer enough of a financial reward to really compound one's wealth over time. So that leaves us with ETFs, which couple solid gains with relative long-term safety. Depending on the ETF, you might expect to generate an 8 to 11% return per year. And if you're consistent, a £500 monthly investment will net you over £1 million over 30 years, all down to the power of compounding. Now, the biggest way that most retail investors mess this up, it's not due to not doing enough research or even having enough knowledge. It's simply because they usually allow their emotion to influence their strategy, or even worse, they try to time the market. When I say you can expect to generate 8 to 11% per year, that's a long-term average. So there are some years where you should really expect to see significant declines, perhaps as large as 30%. This chart of the 30-year returns of the S&P 500 illustrates the point perfectly. Most years are green and much larger than the 11% average, but these are offset by occasional huge drawdowns, and you have to be strong-willed enough to be able to stomach a huge drop in your portfolio with the confidence to continue investing through the turmoil, because it's when you're in the trenches that you'll actually see the greatest return. But believe me, when you're in it, it's not that easy. Now, not all ETFs are made equal, and there are literally thousands of them. So which is the best to invest in? Well, the most common ETFs over the last 10 years have been, well, probably the S&P 500, which is why I mentioned it, and then maybe the Vanguard FTSE All-World, which tracks companies all over the globe, not just the US. And as a beginner, I would point someone in the direction of each of those. Now, despite what I said about passive versus active investing and average Joe and few financial credentials and so on, I actually strongly believe that there is a place for individual shares in most people's portfolios. It just has to be a small proportion, and you have to go into that investment knowing that, well, you might not make a single penny. Or even worse, you could lose it all. Now, I've devised what I believe to be the best portfolio allocation across all investing categories, and I'll be releasing a video of it in the coming weeks. So make sure you subscribe because you're not going to want to miss it. And if there's anything else you want me to cover in a future video, comment down below and I'll probably just do it. So now you're in a position where you know what you want to invest in, but you're not sure where to go to do it. Well, firstly, you'll need to choose a broker, and this will be down to personal preference. There's an abundance of them, each with their own pros and cons, far too many to cover in a single video. A lot of the newer disruptors, such as Trading 212 or Free Trade, offer commission-free investing, which you can save a lot of money on in the long run. And despite what you may have heard, they actually provide an equal level of protection to the larger brokers available. The best advice I can offer you for setting up your investment account in the UK is actually to just make sure that it's done through an ISA, as any gains will be exempt from tax, and that's a lot of tax saved on a £1 million portfolio. So if I can summarize this entire video, it would be these 4 key takeaways. Number 1, start investing as early as you can with as much as you can afford. You should be trying to do this as aggressively as you possibly can because the wonder of compounding is greatest over the longest period of time. Using the earlier example, investing for an additional 5 years can see you almost double your portfolio, which is crazy when you think that it was 30 years to get to the first million and only 5 or 6 to get to the second. The next key takeaway for any beginner is to have the majority of your portfolio in broad, well-established ETFs to provide you downside protection and diversification. The third is to create a regular pattern of investment and stick to it, regardless of what the markets are doing. Remember, your largest gains are immediately following the biggest market drawdowns, and no one can reliably predict when they will be. So just invest all the way through and be consistent with it. And lastly, if you're based in the UK, make sure you invest in the tax-efficient ISA. You'll thank me when you save hundreds of thousands of capital gains tax on your £1 million portfolio 30 years from now.